Okay, well, let's move on and let's come back to the ET Money show and let's continue with our second discussion. Now, investing in the stock markets can be a wild ride for the new investors where people can take a lot of time before they start feeling comfortable with the stock market investing. And there are a number of the do's and the don'ts in the stock market that can be followed by the new investors, and these can help them generate some profits. As we start a brand new year, we thought of giving you a complete guide on how to go about investing and navigating equity markets and the different asset classes. And to discuss all of that, let's bring on board Rushabh Desai, who is the founder at Rupee with Rushabh Investment Services. Hi, very good evening, Rushabh. Thank you so much for joining us today on ET Now. Pleasure having you. Firstly, it was the first trading day of 2023. So let me start asking for anybody who is a new investor into the markets, what as per you 2023 be like in terms of the do's and the don'ts of investing?
Hi, Srishti. Very good evening. Wishing you and your viewers a very happy
Happy New Year,
2023.
Rishabh.
And so that's a great question to start with. So I'm sure you also will agree with me. There are lots of do's and don'ts, out there, and every do and every don't will be different from person to person, individual to individual. But I've jotted down three do's and three don'ts in my view for new investors in 2023, which I feel are very important. So the first do in my view is, before making any investment, investors should identify and understand their goal, their risk appetite, their time horizon, and their asset allocation. See, this is something what I call is the four pillars of investing. So once you define what is your goal, whether it can be for your retirement, wealth creation, your maybe your marriage or buying a home, anything. Once you decide a goal, then comes the next step of how much are you able to stomach volatility? What is your risk? Whether you're able to take a high risk, medium risk, low risk. After that, it comes the time horizon. Whether you want to. I mean, equities are always meant for long term, so investors should keep in mind that a minimum 5 year time horizon should be given for sure at all times. So whether it is 5 years, 10 years, 15 years, and once you decide your goal, risk appetite, and time horizon, then in a systematic manner, one should create an asset allocation, whether it is equity, debt, gold, real estate, etc. So this is number one. Number two is the do is rebalance. A lot of questions are being asked. When should investors rebalance their portfolio? So in my view, first of all, rebalancing one's portfolio and making redemptions should be done during good market conditions. So whatever bad mistakes or we have made during bad times during the markets, good market conditions give us an opportunity to get out of those products or those asset classes and realign or rebalance ourselves. Also, another important thing what investors should keep in mind is that don't rebalance very often. The rebalancing should be done at least 5 years has to be given. 5 years time frame has to be given, and rebalancing has to be done as per your risk. For example, if my equity, if I'm comfortable with 50% allocation in equity, if it deviates to say like 70-75%, one should ask a question that whether 70-75% is suitable or no. If it is suitable, if your goal is wealth creation, if you have a particular goal, let it grow. But if you say, for example, if your risk is not that much, for example, say 70-75%, then a certain amount has to be redeemed and reshuffled into a safer asset class. So that's point number two. Point number three is that in the do's, keep your portfolio simple, keep it non-cluttered, and only sufficiently diversified. Because what we have seen is, I have seen clients having 50, 70, 80 mutual funds in their portfolio, which is absolutely not needed. Over diversification will only lead to dragging down the optimum returns which your portfolio would generate in the long term. So because anyways, each and every mutual fund would have, anywhere between 30 to 90 stocks. So keep it simple, what you can understand, keep it non-cluttered, and just sufficiently diversified, don't over diversify. Now coming to the don'ts, the most important don't is don't take credit risk. This is mainly for the fixed income and debt investors. Don't chase yields. Debt and fixed income can be more riskier than equities at times. So if money is lost in the debt products, in the debt segment, it will be very difficult to recover it, and the process is absolutely time consuming. So debt is meant for capital preservation, and equity is meant for capital for wealth creation, for capital appreciation. So please keep in mind that don't take credit risk in the debt segment. The second don't is that don't stop your SIPs during bear markets, during volatile markets. Don't be afraid. Volatility and bear markets, consider it as your best friend, because when you invest during bear markets, the bear markets gives you an opportunity to invest, at low prices and lucrative prices, and you can accumulate more units. So in my view, true wealth is created when you invest during bear markets and stay put for the long term. That's number two. And number three is the don't is, if see, I'm sure we are in an age where, direct investments, the do-it-yourself investors are increasing day by day. So if you don't understand, I'm not saying that direct investments are bad. No, absolutely. If you understand markets, if you understand how to select the right products, if you understand the dynamics, of that asset class, go for direct investments. But if you don't understand it, go for a good advisor or a distributor. Don't experiment yourself to save 1 or 2% commission or fees. You might actually end up losing much more than you think.
Thank you so much, Rushabh, for highlighting the do's and the don'ts for 2023 for all those investors out there. But Rushabh, that brings me to my next question, because it's the start of 2023. So quickly, if you can tell our viewers that I know that it can be very personalized in terms of making a financial resolutions for themselves, but on a broader sense, on an ideal basis, what should be the financial resolution be looking like for the investors out there?
So I've jotted down 5 financial resolutions for new investors in 2023. Number one is that, as a country, India as a country, we are good at saving, but unfortunately, we are not very good at investing. We have to channelize that savings into investments in order for our wealth to grow. So I'm encouraging at least 15 to 20% of one's annual salary has to be saved and invested for the long term. That's number one. Try to top up your investments, by 5 to 10% each year, as in when your salary increases. Number two, create an emergency corpus. COVID has taught us the value of, so many people lost jobs, and even in this difficult time today, many are losing jobs. So having an emergency corpus, which will take care of your daily expenses, up to 1 or 2 years is very, very important, because we are living in very volatile times. So emergency corpus will really help you, during difficult situations. Number three, invest as per the size of your blanket. Don't go overboard. Don't get carried away by lucrative price levels and by returns. Just stick with what you have decided. Okay, this is the amount I've decided for equity. Let me just, as per my risk and as per the size of my blanket, I'll just stick with that. Don't go overboard. Number four, secure your health. That is very important. Health is wealth. So have an adequate health insurance. Just to make it clear, I'm not an insurance expert, but having an adequate health insurance will save a lot of your money and will be really beneficial in the long term in securing your finances, in my view. And number five, don't be debt burdened. Pay off your debts as per your cash flow, but as soon as you can. Being debt burdened, being burdened by debt for a long period of time may put immense amount of stress on your finances. You may feel psychologically burdened, which is not good for your health. And this may also restrict you in fulfilling your other goals in life. So these are the 5 financial resolutions, in my view, what I'm offering to the investors out there.
Okay, thank you so much for giving us just the broad pointers, like what their financial resolution for 2023 should be looking like. But Rishabh, let's talk some of the different asset classes. Firstly, let's talk about the equity asset class. Because for 2022, when we see the return of the index, they were not that great for the index perspective, but India definitely has outperformed. But coming to 2023, if somebody is looking to invest into equity markets, which are some of the factors that they should be concerned about? And what is your expectation on the front, like apart from different categories and the style of investing, where do you feel that investors should really focusing on in this new year?
Srishti, so in 2023, in my view, the pain of 2022 is going to be carried forward till some extent, unfortunately. So, the global slowdown is going to continue, sluggishness in is growth is also going to continue. Equity as an asset class will be volatile. So, investors should keep their returns expectations low to moderate, in my humble opinion. Now, how should one navigate during 2023? See, the valuations I mean, as you correctly said, yes, India has been quite successful in decoupling itself, from the global volatility. Because if you see, US has fallen like around 30-35%, China has fallen 40-45%. So in that sense, our macroeconomical factors and data has been very strong. So, but in my view, if the global slowdown continues, and if US, which is the mother of the equity market, if US falls into recession, then of course I don't think India would be uh, saved in terms of being successfully decoupling. There will be spillover from the West to the Indian market. So Indian markets can get volatile in 2023. Currently, as we speak, the valuations in the Indian equity markets have little bit inched up above their long-term average and have become marginally expensive. I'm mainly talking from the Nifty 50 point of view. And if you compare India from the global markets, Indian valuations are definitely expensive and on the higher end. So someone who's looking to invest in the equity markets right now, lump sum is not the right way to go ahead. Stagger your investments, and investing via SIP route will be an ideal strategy. And as and when the markets fall, when the valuations fall, lump sum investors can invest their corpus during those correction pockets. Now, 2023 is actually a great year in my view for investors who are looking to take global exposure, especially in the US and China market. As I mentioned earlier, that US and Chinese economy have fallen tremendously. So if someone is really looking to take global exposure, this is truly the right time in my view. And which you asked me that what someone should look at. See, currently, I mean, every segment will rotate. All the winners and losers will keep rotating. But in my view, value as a strategy would do well. And small caps are relatively, at a discount compared to the large cap segment. So maybe small caps and the value segment, in my view, is going to be the year for 2023.
Okay, small caps and the value segment is going to be the year defining 2023 is what Rishabh feels. But Rishabh, let me come to the other asset class majorly used by the investors out there. One is the equity that we have already touched upon. The other one is the debt asset class. Because now what we are seeing that even the RBI is taking some initiatives to get more of the retail participation in the debt side. So what is your view that going ahead in 2023, given the kind of bond yields that we have witnessed in the year gone by, for the upcoming year, what should be the return expectation from the debt asset side of the business? What's your view on that?
Shishi, this is a great question you have asked me today. Since past 2 years, we have seen absolutely sluggishness in the debt segment, mainly because the interest rates were so low. Now, in my view, from 2023, we are actually entering a golden era for debt, and the fixed income investors are definitely going to get superior yields and will be able to generate optimum returns in the next 3 years from the debt segment. Now, see, to fight inflation, central bankers globally, including RBI, have aggressively hiked interest rates. So the yields have also raised tremendously. So if you see currently, the yields in the AAA corporate bond segment, mainly in the medium to long duration space, is ranging in between 7.5 to 7.8%, which in my view is very lucrative. But hold on there. RBI is going to raise interest, interest further. Interest rates are going to be hiked further, in my view, and the interest rate hike cycle is expected to peak out somewhere in first half of 2023. So we are furthermore going to see the yields would rise further. So debt investors, should stay away from medium to long duration products, at least at this point of time. Investors should park their money, in say like short duration products and ultra short duration products for at least 3 to 4 months, and then venture into medium to long duration, because that is the time one would lock in at a higher coupon and higher yields. So in my view, 2023 is going to be very good for the debt segment, and I feel that from today, 3 years down the line, debt investors are definitely going to get some superior returns in the debt segment.
Okay, thank you so much, Rushabh, for sharing your view on the debt side of the business. But let me take up the last question from you, because you have touched upon a lot of different asset classes. What is your return expectation from them? But if sectorally we have to talk about for Indian market perspective, because you did highlight that India and China are some of the areas where you think that money making will be easy and could be in a better way than the rest of the market. So going ahead, which are some of the themes that you feel that can play very well in context to the Indian markets?
Shrishti, in my view, I'm not a very big fan of sectorial funds, because sectors keep rotating every year. But yes, I'm very bullish on 4 themes. One is the global technology and innovation theme. Second is the pharma and healthcare theme. Third is the consumption theme. And fourth is the banking and finance theme. So these are the broad 4 themes, which I'm really, really very bullish on. Now, if someone would ask me, how should I take, exposure towards these themes? In my view, retail segment, the best way to go ahead is investing via flexi-cap strategy funds, because flexi-caps will help give investors a complete diversification in all of these 4 themes. So all of these 4 themes, I took out the data and I saw the category average allocation towards each of these themes. So, flexi-cap funds are sufficiently diversified into technology, pharma, consumption, and banking and finance. So if someone wants to go, invest in these things, flexi-cap would be the best way to go ahead. And in terms of strategy, I feel, as I mentioned earlier, in my view, currently growth strategy is underperforming due to sluggishness, due to sluggish growth and correction of overvalued prices. So in my view, value is going to do well. More focus has to be given towards value-oriented funds. But, both value and growth will have their own cycles. So it's very difficult to predict each of these cycles. So it might as well someone, takes exposure into both. I would recommend growth strategy. Little higher exposure needs to be given towards growth, because growth is relatively more consistent and value is a little bit more cyclical. So higher exposure has to be given to growth, and little less exposure has to be given towards the value segment.
So for 2023, what Rishabh feels the themes that could play well is the technology, pharma, consumption, and banking and finance. So do look out for all of these themes. And also, the growth has to have a little more interest in comparison to the value side of investing. But with this, we'll let you go on that, Rishabh. Thank you so much for joining us today on ET Now. Pleasure having you.